All right, guys. Housing market predictions. This is from Yahoo Finance. Housing market predictions. The forecast for the next 5 years. There's a lot in this. I don't know where you guys want to start, but they're talking about inventory, days on market, homes sold. We're talking about price predictions. We're talking about what people can do over the course of the next couple of years. Brian, kick us off.
All right, so I'm going to go ahead and address the big elephant in the room, and that's will the market crash? And I feel everybody wants to know this. And one thing that Yoon said that stood out to me was that market crashes happens when there's a surplus of houses. And if you know anything about the current real estate market, we're at a shortage by a lot. So that right there just lets me know that there is, chances that it isn't going to crash because of all the placeholders that we have in place to be able to uphold all that if it happens, if shit hits the fan. We have equity in houses that'll be able to go ahead and, take care of a lot of the debts if they need to. But I don't see the housing market crashing because of the fact that houses are going to crash. There's none for sale.
Yeah. And again, I think if people are finding themselves in financial duress, they have the choice of selling if they have equity. Yeah. I mean, I think you will see it was just a couple shows ago, we were talking about delinquencies being at their 38-year low. That's for a reason. It's because those payments are easy to make. They're lower. We refinance half the planet like we keep joking about, but there's legitimacy to that. I mean, our two top funding years in the mortgage industry were 2020 and 2021 for total volume of loans refinanced. And they were also at the trough of when we've historically had fixed rate loans for 30 years.
Artificial.
This article actually references that within 2 years, they think we'll be back at 5.5 to 6. And that possibly by the middle of 2024, to Mikey's point, the quarter 2 2024, that we'll get back to 6%. So anyone who's looking at the next 3 months, 6 months, 9 months, take note of that, and then also prepare and plan for getting through 2024 and looking into 2025. If you're going to be purchasing at the 7, you're looking to refinance at the 6.5, 6, 5.5. You're going to need to plan for 18, 24, maybe 36 months on the long end in order to do that, and then eventually come back to save some money.
No, that's right in coordination with, I feel, what everybody should be doing right now. And I honestly feel that there's going to be a lot more creativity in certain products for, financing, like for business owners, for, self-employed borrowers. Like ARMs, I think, will be a little bit more popular, bank statement loans. And the reason being is because if you're able to get into something right now, weather it out, and then refinance back to a traditional loan down the line when, in 2, maybe 3 years tops when rates come down, then you'll be able to still reap the benefits of everything. Because as we see, houses aren't going to decline crazy or crash for that matter. And even if there's a 5, 10, 15% correction, there's still enough equity built into the houses to be able to withhold that and still make a good enough, buck on your investment. So I feel that there's still a lot of upside for prices. They won't drop. They'll maintain and continuously go up because of the fact that there isn't any houses and they're not building anytime soon. If you guys been paying attention to builders, they're staying steady. So I don't know.
And that dips into a conversation we had last time, which was, at what point do the people sitting in cash on the sidelines jump in the game? Mm-hmm. Is it when they see a 10% correction or a 10% haircut or 15%? And how they jockey with one another to try to get in before the next guy who's trying to get a deal?
Well, guys, here's the way I see it. I mean, because I feel like, maybe I bring a little bit more of a consumer's perspective just because, at the end of the day, you guys have more experience than me. But the way I see it is what happens every time something is bad in the market, like right now. It corrects itself. The market goes back to normal. So if we're looking 5 years ahead in the future, by that point, I feel, we can expect a corrected market and things kind of back to normal as well.
Yeah. On what time frame? Did you say about 5 years?
Well, I'm just saying referencing 5 years just because, that's the article we're talking about.
Yeah.
But it could be sooner, 2, 3 years maybe.
But I feel like, look at it. If we do start bringing rates down, what's going to happen right away? Inflation, spending, and everything just goes right back to where we're at. So saying 5 years, I feel is, in line because of the fact that we do need to see enough time, read enough data to really make the prediction or make the decision that, hey, this is, I think, our time to basically shut it down.
Yeah.
And until that happens, I feel we're still going to be in the same predicament.
So the article is talking about this 5-year window, but let's take our personal take right here. It's like when do you individually think that we'll return to what we would traditionally call a buyer's market, where buyers are back in the market, they're off the fence, and you see buying frenzy? What would you say that's going to be? What year would you guess?
I'm going to go out on a limb here and say Q4 2024.
Oh, that was specific.
I'm saying by Q4 2024, it's possible we can maybe be at that 5% golden mark.
Brian, what do you think? When do you think a buyer's market returns?
I feel a buyer's market returns once unemployment goes up and people start selling their houses. I can't give a specific time because we still haven't seen softening in the job labor market. But once we do see a huge spike in unemployment, then I can see a lot of buyers jumping into the market because there's going to be a lot more houses for sale, therefore alleviating the prices of homes a little bit and giving people the opportunity to either get in with the lower rate or get in with lower prices.
Yeah, I think it's
what year did you think that was?
I didn't put a year.
No, he's not saying year. He's saying conditionally.
Yeah, so I'm going based off of data. Yeah,
you gave me a year, which is good. He gave me a condition, which is also good. So you think it's a condition of unemployment, and then there having to be more houses come to the market.
The reason being is because they've had said times, they've had said certain dates of when things were going to slow down, when things were going to happen, and then once we get there and the data doesn't correlate with what they're saying, then I'm like, okay, well now I believe the data more than what I believe their personal assumptions are. No disregard to what you said at all.
Yeah. It's okay, and I am going to give a time answer. Mine is 2025. Mine is 2025 because of how long it's taken for us to get this far for the Fed to address inflation.
Yeah.
I am honestly concerned about the reinflation, even if it's just a mild uptick. It's an uptick, number one. Number two, I honestly think that 2024 will be absolutely wild when it comes to whatever's happening with the election stuff. I think that's going to actually take a lot of people and go, hold on, let me just wait and see what happens. I'm not talking about buyers necessarily. I'm saying industries are going to go, hold on, let's see. And then now I know what I'm dealing with. Now I can return to the market. And at that same time, I think we will start to see the impacts of these elevated and held for longer higher Fed rates that will be impacting people on the personal level. I think buyers come back in 2025.
Okay. We'll see.
We all got different perspectives again.
All right. I like that.
No, yeah.
Okay. So, so there's other stuff in this article, guys. They had some tips for buying a home. Let's take us out on a high note today. Let's talk about these things. The first thing to mention is thinking about earning power. The second is decrease debt. Third is improve your credit score. And fourth is focus on your local area. Mikey, what's your opinion about this? Like, do you carry the same weight as the article does and that these things are all equally important when planning?
I guess if I had to move it, I would move improve your credit score over decrease your debt. Because, of course, as we know, we have seen people with, quite some debt still being able to be in a good position to purchase. For the most part, I would agree, though. Of course, the first thing is going to be having earned income. I mean, do you even make enough income to qualify? The reason why I put credit over decrease your debt is because it's not 100%, but it kind of determines, what kind of rate you're going to get. And as far as decreasing your debt, once again, everyone's in a different situation. You might have more debt than other people, but, for your specific situation, it might be fine. So, but ideally, if you could decrease it, that'd just be better and have a lower monthly payment.
How about you, Brian?
I think for me, one that gets downplayed is focus on your local area. Everybody gets focused on what's happening, all over the place, through the media, through headlines, that you really forget to focus what's happening in your backyard. And I feel that's where, there's a lot of gems where you could learn how your certain neighborhoods are selling, what incentives there are in certain areas of the city. And I feel that's going to ultimately, bring more opportunities. And if you're able to have the right information, you're going to make the best decisions. But I feel understanding what your market is and how your market's performing, how houses are selling. Like, who cares what the national median is? Yeah. What's the median in your neighborhood that you want to buy at? Like, that's the type of information you should be looking at. The turnaround, how the community is performing, all that stuff you need to learn about your community, because the finance stuff will get taken care of, and if you have the finances, everything will be okay. But you got to make sure that where you're living at also goes along with what your goals are. So I feel that that's also as important as everything else.
Absolutely.
Yeah, that's good. I was listening to you and I was thinking, I actually changed my answer because what you guys were talking about, because what I was going to say was you got to make sure your employment and your savings are in place first. Like, having cash reserves is good because for any situation, for any economic anomalies that might be happening. But when you mentioned the local market thing, it really kind of dawned on me that what my summary answer is: identify what gets you in versus what keeps you out. So whatever's going to get you in is what the things you need to work on, and what is going to keep you out are the things you have to attack and you have to manage and overcome. So if you have poor credit, it has to be credit first. If you have no job, It has to be job first. If it means you have zero savings, you have to have savings first. If you have to pay down debt, then you have to pay down that debt. So where are your threats and opportunities? And then approach it from that perspective, because everyone's situation can be different. Yep. And then local markets are economically going to help you either get in or keep you out. You might be able to get in a less costly area that's an hour and a half, 2 hours north of here and have a long commute. First is try to live in the city, but not able to be afford. That might be the difference between being a homeowner in San Diego or not, or in Temecula or not.
And Andy, can I challenge you with a question?
Yes, go. Let's do it.
So I know you said, prioritize it by the things I'll get you in and
Yes.
things I'll get you out. But
Yep.
with all things equal, what would you put them in order?
I would say decrease your debt. Yeah,
Okay.
because you have to have a job anyways, otherwise you're not getting a loan.
Yeah.
So the first functional thing you can do is actually decrease your debt.
Yeah.
It is always going to help you. It will never hurt you by decreasing your debt. But when you decrease your debt, note to everyone watching, do not close your credit lines. Keep them open because the history helps you and the zero balance helps you even more.